Good morning, everybody, and welcome to this edition of our weekly Think Tank for Monday, 12 July. My name is Carl Capilingua, and I'm the market analyst over here at Think Markets Australia. It is a pleasure to be with you as we delve into all of the key moves on the key markets from last week and then look to the week ahead. Let's kick off with the market moves here in Australia. Not a great week for the ASX 200 overall. You can see they're down 0.48%. Within that, best performers, energy up about 1.3%, gold up about 1.2%, materials up 0.63%, staples up 1.4%, and utilities up just under 0.5%. But it certainly felt that there were more stocks on the downside than the upside. Discretionary down about 2.7%. That was the hardest hit of the decliners. Healthcare next with 2.2%. Financials down 1.2%. Technology down 1.7% despite new records on the Nasdaq in the US. Property trusts 0.4% to the wrong side there, and telecoms down about 1.7%. Interestingly, quite a large spike in the ASX Volatility Index. But look, overall, we have seen a trend over the last few weeks anyway, lower in volatility. Having a look at the chart of the ASX 200 now, we can see that we are still very much in a short-term uptrend and a long-term uptrend. The short-term uptrend is the light green zone just through here, and the long-term uptrend is the dark green zone. And we can see why the volatility, at least in the short term, has been on the up, and that's because we have seen a rather choppy trading range over the last 2 to 3 weeks as interest rates, bond yields, have fallen back from their late March highs. Now that has had an adverse impact on our local financial services sector, particularly the banks, who tend to struggle when, not so much when yields come down, but when the yield curve flattens. So that is when there is a smaller difference between very short-term yields and longer-term yields. Don't forget, banks, they borrow from us in the short term, pay us very little on our deposits, very little now indeed, and then they lend to us in the long term and earn higher rates of interest there. So they like it when the interest rate curve is steeper, because it means a higher differential between what they pay us and what we pay them, and therefore that means higher profits. And because banks have such a huge weighting in the Australian market, their underperformance has, I believe, been a substantial drag on the Australian market. But with these trends still up, I'm happy to back, certainly holding your current positions, if not adding strategically to your portfolio, if you've got some cash on the sidelines. As long as we're above 71.73, 72.16, I do believe that the bull case is still very much in place. And the highest probability, most likely outcome, is that we do break through 74.07 and then put another leg up in this very strong overall trend. If we got below 7173, certainly I would have to reassess things, but let's stay the course for now. Having a look around the world, global markets here. Asia, not too good. Nikkei down 3%. Hang Seng down a sharper 3.4%, but the Shanghai Composite was largely flat. Best performing region, no doubt, the US markets, with the Dow Jones, S&P 500 and Nasdaq all up nicely. In particular, Nasdaq doing well. The technology stocks, a major beneficiary from those declines in bond yields. Volatility still a little bit higher for the week, but much like the Australian experience, trending lower, significantly lower over the last few months. In Europe, pretty quiet. Congratulations, obviously, to the Italians for their big win last night in the Euro Cup. Commiserations to the English. No commiserations for US stocks. The Nasdaq here, I could have picked any of those indices, but I just wanted to show you the strength of the trends. The short-term trend very much to the upside, the long-term trend also very much to the upside. And what a wonderful set of candles we have here. When you have lots of these white candles, it just tells you that there's a great deal of latent demand in the system. So latent demand is the demand that is lying in wait, waiting to purchase on any pullback. And the way you get these white candles is, if you could imagine, this is a Monday, for example, and then Tuesday we open down here. So it looks quite bearish, a negative open, but by the end of the session we have powered higher and closed on the highs. And this is what creates this white candle here. We might have some shadows, but the more white candles you see on the screen, it really does speak to this, sustainable lying in wait demand in the system. I'm pretty happy with the way things are going in the US, and I think that bodes well for us over here in Australia. Having a look at the base metals now, or base metals and other commodities. Nickel, the standout performer there, 2.35%, what was generally a higher week for our metals. Iron ore, good to see that popping a little bit back up, and gold recovering 1.2% of its recent falls. A little bit of a focus here on nickel today. So we're looking at the London Metals Exchange official cash close for nickel, and the prices in US dollars per tonne, just pushing through a little bit of a resistance point here at 18,600. Next stop probably that 19,689 level, but otherwise a very, very constructive trend, a nice consolidation after this dip back here in late February, and with higher peaks, higher troughs resuming. After this little consolidation phase, I can't see why we can't go up and test those all-time highs and maybe even go a little bit further. I've got a few very interesting nickel stocks for you later on in today's presentation. Moving on now, energy had a slightly softer week, down around about 1%. The Australian dollar was a little bit weaker, even as the US dollar fell more broadly. And the biggest news from last week, without a doubt, was in the bond market. Now, the bond market is the largest financial securities market in the world by a long way too. So when the bond market moves, as stock investors, we do need to take note. And what we're seeing here in these fall in yields is actually a rally in bond prices. So investors moving back into bonds. You might ordinarily think, well, that's bad for stocks. And historically, often it is, because investors choose generally between either stocks which represent risk and do well in a strong economic environment where earnings tend to rise, of course, or bonds where they're very safe, very boring, pay typically a guaranteed yield if you've got something like a government bond, and you tend to do better in bonds when economic growth isn't as good. So we've got this very interesting situation where bonds and stocks are going up, and probably speaks to the amount of liquidity that central banks have pumped into the system, facilitating the ability for investors to be buying both at once, but also potentially a bit of an unwinding of the reflation trade we saw earlier in the year, where we saw yields on screen now, rising through February and March very sharply as investors started to factor in higher inflation down the track from generally the impacts of COVID negatively impacting the supply side of the global economy. We have certainly seen some much higher prints on consumer price inflation indices, producer price inflation indices, and other inflation measures out there. Yet, at the same time, we're still seeing this gradual, fairly gradual compared to the rise, pullback in bond yields. More to do, I think, with the fact that people are believing that the inflation that we will experience is going to be transitory. That is mainly due to these one-off impacts of COVID, and as supply gets back online, we'll see things return to normal. Also, of course, we're seeing bond yields coming down because there is this great deal of liquidity, and partly because the Fed is actually buying these bonds also. Interesting little reversal there on Thursday, Friday. Typically, we would expect this to result in at least a little bit more of a bounce, and it's happening at a pretty key level here in this long-term uptrend zone, and not far off the key static support here at let's call it 120. So look, I think we're probably bottoming out in this 120 to 130 area. We're certainly topping out there. And as long as we are somewhere in here, this is what we call the Goldilocks zone. Not too hot, not too cold in terms of economic growth. Not too hot that the Fed will need to hike up interest rates to slow things down. I don't think we're anywhere near that anytime soon. And not too cold where we're going, well, if we're down here, the economy really is in trouble, and therefore, stocks would need to sit up and listen. So we're okay for now on that one, long story short. Pretty quiet week in terms of the data last week. ANZ job ads came out at plus 4.7%, which is obviously a good thing, but we are seeing a general downtrend there. So, Reserve Bank certainly nowhere near, I think, feeling that the Australian economy has returned to full employment, and therefore they would need to do with anything with interest rates, and that's why we saw last week they kept interest rates on hold at 0.1%, and the market was totally expecting that one. Data in the US, again, a quiet week. We saw the services PMIs come out a little bit better than expected there, 64 versus 63, and slightly up on the previous month. And I think the trend, as your friend there, was still heading in the right direction. Weekly jobless claims came in a little bit higher than expected there, 373,000 versus 345,000. And that was a little bit worse than their previous week's reading, and we are kind of flattening out here after this very nice period of losing less jobs in the US economy, and that again is consistent with the Fed staying the course on these relatively easy monetary conditions. Having a look at where the value is in the Australian market now, we can see we're trading at about 17.25 times next year's earnings. That compares favourably to about 19 times for the rest of the developed markets out there. So we're cheaper than the rest of the world. I'm not sure if that's helped us all that much over the last couple of weeks. We saw some of the underperformance recently, and that is because our average PEs are lower than in the US. We've seen great record runs in the US, and the S&P 500 has a PE of about 22, 1 year forward PE of 22, and the NASDAQ has a 1 year forward PE of 26. Now here's the thing about the Aussie market versus the US market. Obviously we've seen some underperformance here. We've talked about the impact of lower bond yields of a flattening yield curve on Australian banks, which are a large part of our index. That explains why we've underperformed. The other thing is, of course, those falling bond yields tend to favour what we call longer duration, higher PE, in brackets, more expensive stocks, for example, US stocks. So US stocks have done pretty well as interest rates have come down. Australian stocks, mainly financial stocks, have struggled a little. Where do we go from here? Well, depends on that bond yield chart we talked about before. If we see a stabilisation, a slight gradual move back up, it's going to help our banking sector, help, I think, other parts of the Australian market that were benefiting from the slightly higher rates, and probably not damage too much those that were benefiting from the lower rates, I believe. So I think we could see a little bit of a catch-up on the Australian market compared to the US market. Having a look at the cheaper sectors at the moment, the materials sector trading at just 10.5 times earnings, quite extraordinary. I would classify that as almost bargain prices there compared to some of the other sectors here. Energy, quite attractive too at 13.7 times. Then the financials, I wouldn't say that's particularly cheap. They're at 16 times, and they go from there up to technology, which is at about 62 times earnings, and that has increased substantially over the last month as tech stocks have rallied. Why are material stocks so cheap? Well, I think it's got a lot to do with the assumptions that the big broking houses have made on commodity prices, and many of these big research houses are expecting commodity prices to fall, and therefore that will depress the earnings of commodity stocks going forward. But in reality, what has happened is that commodity prices have stayed stronger for far longer than many of these brokers have anticipated, and I do expect that we will see continued upgrades in commodity price forecasts, and then accompanying increases in some of these materials stocks, commodity stocks, price targets, and therefore price appreciation. So I'm still quite happy to invest in the materials sector, and even the energy sector. I think there's still some very cheap stocks there as well. Having a look at some of the technical analysis insights I've got for you today, and what we're looking at here is how various stocks within the ASX 300 are performing compared to their moving averages over various timeframes. And what we want to see here is, number one, a significant amount of performance within the ASX 300, so a significant percentage of stocks doing better than those moving averages in uptrends. And we're not really seeing that at the moment, unfortunately. So if we look at where we were a week ago, which is the yellow line, and a month ago, the participation of stocks in solid uptrends within the ASX 300 has fallen significantly, and to a point where I'm starting to get a little bit concerned, actually. So we do want to see this bounce back up this week. Otherwise, we might have to make some adjustments to our expectations of the underlying strength of some of those technicals we reviewed earlier in the presentation. More specifically, within the ASX sectors, we are seeing still strong trends in the discretionary sector, although this short-term uptrend is coming under some pressure. Energy looks very interesting in that we have moved into a short-term uptrend, but we've still got this nagging sort of neutral, indiscriminate trend there in the longer term. Financials, for the first time since October last year, have moved into a short-term downtrend. We've talked about the reasons why, but the long-term trend is still up, so I would definitely hang on to my financial services stocks. I'm not interested in the gold sector at the moment. Gold stocks, whilst they actually look very cheap, have great cash flows, and there's some really interesting ones out there. The trends just aren't there at the moment, so I'm still avoiding, or at least watching closely that sector. Healthcare has had a bit of a pullback, but I think it's one to keep an eye on. I'll let you know when I find some really interesting plays there. Technology, I would stick with. Materials, I've got some buys for you coming up in that one. Definitely stick with it. Property trusts, I'm still pretty happy with, as I am with staples, and telecommunications would be the other standout I would suggest from materials. Not interested in utilities at this point in time. Let's have a look at some of the charts of those sectors, and what should stand out very clearly is, one, the underperformance of the financial services sector over the last few weeks and corresponding with those falling bond yields, and also the similarity between this chart here and the ASX 200 chart from earlier before, again illustrating how much of an impact these stocks do have on our index. The other chart I'm going to show you today is the materials sector, which I still think looks pretty good. We're in a bit of a trading range here, but short-term uptrend is in place, long-term uptrend is in place, so I'm still happy to try and find some cheaper stocks within the sector. For example, I can give you in terms of nickel stocks. We looked at the chart of nickel earlier on. IGO Group, I think, looks very, very good on the chart. Mincor is consolidating, but I still think is in a very strong trend. And Nickel Mines is on the watch list at the moment. It is pulling back, or has pulled back over the last few months, but has built a nice base pattern over the last few weeks. And I think if this one gets through maybe 111 or 112, then it's definitely worth a look at. So maybe that's one to keep an eye on this week on the chart. I like Iluka. They do mineral sands, obviously. And in the rare earths sector, I like Linus Corp. That's probably my favourite chart at the moment, actually. So definitely check those out. In the telecommunication sector, I said this was the other key sector to watch. You can see just the strength of the short-term uptrend there, as well as the long-term uptrend. And a few stocks you might want to look at here are Enero Group, which I think is starting to look very good on the chart, IVE Group, which we have featured a number of times in our discussions over here at Think Markets as a buy, and a new one on the list actually is Macquarie Telecom. That's actually starting to look quite good as well. If I had to pick between the three, if I had to pick one, I'd probably go for EGG. It is just very, very cheap, and the chart's looking quite good, and maybe I'd go 2 and 3 if I had to order them from there. Looking to the week ahead now, and a fairly busy week for us here in Australia. We do have the NAB Business Confidence Survey coming out tomorrow, the Westpac Consumer Sentiment Survey coming out on Wednesday, and then the big one for us is the employment data coming out on Thursday. We are expecting 20,000 odd jobs to have been created last month in June, and the unemployment rate to come down to 5.1%. Having a look abroad, and it's actually also another very busy week, and more so because of the type of data that's coming out. So the inflation data here in the US on the consumer side of things, and then on the wholesale side of things here with the producer price index, very important for markets at the moment. We also have Jerome Powell, the Federal Reserve Chairman. It looks like a 2-day testimony here. I'm guessing, therefore, in front of the US Senate. That's typically how that rolls. And what we call a data dump. That's officially what it's called, data dump in China, where we're going to have fixed asset investment, industrial production, retail sales, unemployment rate. That's obviously after the FDI. On Tuesday, we'll have weekly unemployment claims, industrial production, and the University of Michigan survey as well. So very, very busy week. It's always a busy week over here at Think Markets, and tomorrow we're going to be doing our top 3 ASX turnaround stocks revisit. Earlier on in the year, we had a look at Kogan, Appen, A2 Milk, and Treasury Wine Estates, and I was quite correct in saying that at that time they were not a buy. They have fallen significantly even from then. Let's check out what they're doing now, see if they're a buy now. We'll add another interesting stock to the mix. Of course, we do have other webinars that you can register for. Ask the experts where you get tune in and ask me anything, really. Bring your portfolio to the table, and a few other educational ones there as well. You need to go to www.learn-to-trade/webinars to register for those. Oh, of course, you're probably watching me on YouTube, so make sure you hit that like button and also subscribe to keep in the loop for our future updates. Look, it's been a pleasure chatting with you today. All the best for your trading until we catch up again. Bye-bye for now.